Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. So it happened. The Fed brought the market back to reality right here. Jerome Powell made his speech right here, and as he was making that speech, the market began to move down aggressively. A 2.5% down day, pretty aggressive, very similar to some of the other big down days we've seen following previous Fed meetings and disappointing CPI reports. Investors have almost gotten used to this type of reaction from either the Fed or economic data releases. So is this the end of the world? Is this where we should be flipping short after this bear market rally and expecting major move down in the market? I know there is a big chunk of investors that still expect volatility on the SP 500 to break out of this pattern here and reach capitulation levels, which really has not happened yet. And so there are investors of the opinion that we should be waiting for that capitulation before even considering becoming bullish on the market again. So we're going to take a look at that in detail in this video and assess those probabilities objectively. We try and be right on the market. We try and be correct about the market. We have all the reason in the world to be as objective as possible on what's going on in the market today and to try and protect and prepare ourselves for the scenario that we think is the most likely. By the way, if you are new here, don't forget to smash that subscribe button because we make these videos multiple times a week covering things that are happening on the market, opportunities, risks. And if you enjoy this episode, make sure to smash that like button. It really does help us out. So if we go back very quickly to an article that we posted on the 21st of October, we highlighted this chart right here with some of the key targets that we have for the S&P 500, the key resistance and support levels that we're really looking at. One of them being 3,900 points because of these big reactions, right? Reaction back here throughout the month of May. Then during the summer rally, the market struggled to move higher. Then once it broke out, you can see that really set off the next leg of the run. Breakout, retest, resumption, and a big move higher. And then on the way back down again, it did act as a level of support where the market hesitated for a while here throughout September. So you can see here textbook test of that resistance and a reversal after the Fed meeting. The market was waiting for a confirmation that either it was all green lights to move higher, the Fed was becoming dovish, or that we should still be in a period of market volatility. Now here, if we add the inverted 10-year yield, this is something we've talked about extensively throughout the last few months. And I know there's quite a few channels out there that have started actually showing the same chart as us because it is really visual, right? It really does help you understand today's market environment. And this is not always the case, right? This just happens to be a market environment that is being driven by rates, by the expectations of monetary policy, and a great proxy for that. And what seems to have been one of the most accurate bond yield is the 10-year yield. You can see that perfect relationship between the stock market and the inverse of the 10-year yield. Now you can see every time, and we discussed this in the last video, so you can check it out towards the end of the video. We talked about this. We discussed this exact phenomenon that every time the market moves higher with bond yields not confirming that move, well, you eventually have seen stocks snap back to reality, right? It's happened again and again, right? March, again, right there, bond yields not confirming, stocks snap back to reality. Again here in September, market getting excited here without bond yields, and stocks snap back to reality. First of all, that doesn't mean that we're going to have the same market environment forever, right? Bond yields are not always smarter than the stock market. It just happens to be that in 2022, bond yields have really been ahead of the game in terms of understanding what the market environment is about. And you can see here on this move up, we had the market move higher. First of all, the market bottomed before the reversal in bond yields. So there was already this anticipation, this front running from the market leading up to the reversal in bond yields, which we didn't see in June, for example. Here in June, you can see bond yields reversed right there, and then the market bottomed. Right, very different to what we've seen in October. You can see the market was getting excited ahead of that reversal in bond yields and was covering a lot of ground very quickly. You can see in terms of the proportion, and here we're just eyeballing things, staying very visual, and we're going to talk about, what all of this means looking ahead, right? Just focusing on this relationship, you can see the stock market retraced a significant portion of its move down that we saw throughout the months of September, retraced almost half of that entire move down, while bond yields were really not getting that excited. So there was this front running of the market that did leave it to a risk of having a little bit of a snapback to reality. So we've had that, right? The Fed snapped stocks back to reality, back to where the bond market is trading at. But the question now is that actually going to turn into something a lot bigger, just like it did, for example, right here, right? You had the snapback to reality in September, and then you had follow through. Same thing we can say again, for example, same thing following the Jackson Hole meeting. We had an initial snapback to reality, and then you had follow through throughout the next few months. That scenario where you have follow through requires yields to keep on moving higher, right? So you would need to see that orange line here, the inverse of the 10-year yield, to keep on moving down for the market to really see follow through, take out the lows, and even see a larger move down. Of course, unless you have a black swan event, a major bank going bust, and unemployment skyrocketing, right? But that's not for now an environment we're currently in. We've discussed that extensively on why we don't think that's an environment we're currently in and we should expect imminently, but that's a question for another day. In order for there to be follow through on this move down, we need to see what is happening on the 10-year yield and compare it, for example, to what we saw during the Jackson Hole meeting. Now, the Jackson Hole meeting was pivotal right here. This was the Jackson Hole meeting on the 25th of August. Here you can see markets really began to move down following that meeting, but observe the type of price action we're getting on bond yields throughout this period. Let me remove the SP 500 and you can see bond yields trending higher, very, very aggressively recovering after a period of consolidation. So they're really moving higher here. Personally, I do think that's different to the setup we have today. First of all, we had a breakdown here of this trend line. Breakdowns don't occur for no reason. The bond market wanted to price something in here. A break of that downtrend line is significant, and now we're seeing that retest. This is just a classic for now. Just looking at this very objectively, this is just a classic breakdown of the trend line, retest, and now we're going to see what happens. And I really am trying to be as consistent as possible here. I'm not trying to prove that we got certain things right or didn't, but in the last video we discussed this exactly, that we have a breakdown, but if we get a retest of that trend line, that can cause a little bit of turbulence on the market, right? And so that's exactly what's happening. We're getting a little bit of turbulence on the market as the 10-year yield, as bond yields have one more leg up here. But you look at the momentum of the 10-year yield, I don't think this looks very similar to the momentum on bond yields we had towards the end of August. It's very different. August here, massive momentum here on bond yields recovering, very powerful rally on bond yields. Here, we actually have fading momentum. You can see high, higher high, potentially another higher high on bond yields as momentum is fading down. To me, that looks a lot more like the technical setup we had right here, where bond yields were making higher highs as momentum was cooling down. That's really what I think is important, strictly from a very intermarket standpoint. If bond yields take out their highs, if bond yields make a marginal new high, as we just discussed, without really going parabolic, right? What you don't want to see is bond yields start to make a move like this. Okay, if this happens, the market is going to tank. I'll give you that. And if this happens, that's a massive blow to the short-term bullish case. The market's not going to rally with this type of move on bond yields. But this type of move, you could potentially expect the market to hold around at these levels of support at around 3,650 points and then reverse back higher again. By the way, if you're learning something from this video, even if you don't agree, if you're finding it helpful in any way, don't forget to smash that like button. It really does help push our channel out, so it is really appreciated. And by the way, we will be posting an article reviewing the FOMC meeting, what they actually said, and whether or not this actually changed anything about the markets. Previous meetings, such as the April meeting, the August meeting, the January 5th meeting, the November meeting, a lot of these meetings brought the market a lot of new information that could get priced in over the next few months. And we saw that in the Fed funds curve, we saw that in rate hike probabilities across different time horizons. So we're going to be looking at that in detail in an update that we'll be posting tomorrow on the website, because I do think there's quite a few very interesting developments you'll guys want to see. And of course, in any case, all of these convictions, all the research and the opportunities that we find across the financial markets, across the globe, we balance it out into our model portfolio, because we don't expect you to be able to read all the research that we post every day, which is why we funnel all of this research down into this feature, into monthly recaps of the research, into the watch list that we have on the key assets that we're looking at. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button, and also subscribe if you haven't already and you want to follow us for more content. Now, in the meantime, I wish you good luck on your trading, and see you next time.